$38.56 trillion. That's not just a staggering figure buried in some government report. That's a ticking time bomb aimed directly at your savings account and your future security. Right now, as we speak, the U.S. national debt has ballooned to levels that have historically brought down entire empires, according to the latest Treasury data from February 2026. And BlackRock, the global powerhouse managing $14 trillion in assets, is raising red flags through their CEO Larry Fink's recent warnings that this debt spiral could erode confidence and turn the dollar into something resembling monopoly money. If you've ever opened your monthly bank statement and wondered why your hard-earned dollars seem to buy less and less each year, or why it feels like the financial system is stacked against everyday people like you while elites always land on their feet, you're exactly where you need to be. In this deep dive, we'll unpack the timeless debt cycles that have repeated for over 500 years, explore why BlackRock is shifting strategies amid these warnings, and reveal what it all truly means for protecting your savings in any economic era. Stay with me. This isn't about fear. It's about arming you with the knowledge to navigate what's ahead. But let's pause for a moment and make this real. Imagine this scenario. You've worked tirelessly for decades, scrimping and saving, maybe skipping vacations or delaying that home repair to build a nest egg for retirement or your family's future. You check your account balance, and it looks okay on paper. But then you head to the grocery store, and the same cart of essentials that cost $150 last year now rings up at $200 or more. Or you glance at your 401k, and despite the numbers ticking up nominally, inflation is quietly gnawing away at its real value, leaving you wondering if you'll ever truly retire comfortably. This isn't some abstract economic theory. This is the lived reality for millions right now, as the U.S. debt climbs relentlessly. According to the Joint Economic Committee's February 2026 update, the national debt stands at $38.56 trillion, up $2.35 trillion from just a year ago, growing at a staggering $6.43 billion per day. That's $267.76 million every hour, $4.46 million every minute, or about $74,379 every single second. Let me explain what this really means on a human level. Those dollars aren't just numbers. They're the fuel for inflation, the silent thief that diminishes your purchasing power without you even noticing at first. Interest payments on this debt alone now exceed $1 trillion annually, more than the entire U.S. defense budget, forcing the government to borrow even more, which in turn pressures rates higher and squeezes everyday borrowers like you with steeper mortgages or credit card bills. And while you're grappling with these rising costs, institutions like BlackRock are adapting swiftly. Their recent outlooks highlight a bearish stance on long-term U.S. Treasuries, citing AI-driven borrowing surges and fiscal strains that could push borrowing costs even higher. This is not about pointing fingers at politicians or parties. This is about recognizing the systemic pressures that affect us all. Right now, as we speak, this debt load is over 130% of U.S. GDP, a ratio that has preceded major economic shifts in history. If you felt that nagging sense of financial instability, like the ground is shifting under your feet, know that it's not just you. It's the early tremors of a cycle that's played out before. But here's the good news. Understanding these patterns can give you the tools to steady yourself. And to truly grasp why this matters today, we have to step back and look at the bigger picture. Because history isn't just a collection of dusty facts. It's a roadmap that shows us where we're headed as we pay attention. Picture this vivid scene from the 1500s. Spain, the undisputed superpower of its time, with fleets of ships hauling unimaginable quantities of gold and silver from the Americas. Their economy boomed initially, flooding the markets with wealth that seemed endless. But what happened next? That influx led to rampant inflation, as too much money chased too few goods. Spain's debt-to-GDP ratio exploded, wars drained the treasury, and they began debasing their currency by mixing in cheaper metals, essentially printing money in medieval form. Within a century, The once mighty Spanish Empire fractured, losing wars, colonies, and economic dominance. Fast forward to the 1600s, and we see a similar tale with the Dutch Republic. They revolutionized global trade with innovations like the stock exchange and joint stock companies, amassing wealth through spices, tulips, and colonial ventures. But endless conflicts with England and France piled on debt, pushing their ratio to unsustainable levels. By the 1700s, the Dutch guilder lost its reserve status, and power shifted to Britain. Now here's where it gets really interesting, and a bit eerie. Britain's story in the 1800s and 1900s mirrors this almost perfectly. They built the largest empire in history on industrial might and colonial exploitation. But two world wars ballooned their debt to over 250% of GDP. Inflation soared, the pound sterling was devalued multiple times, and by the Bretton Woods Agreement in 1944, the US dollar took over as the world's reserve currency. What if we're witnessing the early stages of a similar handover today? These aren't random coincidences. They're a recurring cycle, every 80 to 100 years, driven by the same forces: overborrowing to fund expansion, currency debasement to pay bills, and a gradual wealth transfer from the productive middle class to creditors and elites. According to IMF data, global debt today stands at $251 trillion, about 235% of world GDP, levels that echo those pre-collapse peaks in history. But here's a key twist many overlook. These cycles aren't always violent crashes. Often, they're slow erosions where everyday people feel the pain, first through higher costs and diminished opportunities. Think about the Roman Empire in the 3rd century. They debased the denarius from pure silver to mostly copper, triggering hyperinflation that wiped out savings and led to societal unrest. Or closer to home, the US in the 1970s with stagflation, where debt from Vietnam and Great Society programs combined with oil shocks to erode the dollar's value by 50% in a decade. If you've ever asked yourself, why does it feel like no matter how hard I work, I'm falling behind? This is why. These patterns show that debt cycles amplify inequality, debasing currencies and shifting burdens downward. But understanding them isn't about predicting the exact end. It's about recognizing the signs so you can position yourself wisely. And right now, as we speak, with US debt growing faster than the economy, we're in a phase where those signs are flashing brighter than ever. Just consider the actions of those at the top. Because if history teaches us anything, it's that elites don't wait for the storm to hit. They read the winds early and adjust their sails. Take BlackRock, for instance. This isn't some small firm. They're the world's largest asset manager, overseeing $14 trillion, an amount larger than the GDP of entire continents. Their strategies influence markets globally, and lately, they've been sending clear signals. In their 2026 investment outlook, BlackRock has taken a notably bearish view on long-term U.S. Treasuries, those supposedly safe government bonds that form the backbone of many retirement portfolios. Why? Because, as they explain in their reports, the combination of AI-fueled borrowing needs, persistent fiscal deficits, and geopolitical tensions could drive borrowing costs higher, making those bonds less attractive. This is not idle speculation. It's based on concrete data from their Global Investment Institute, which tracks everything from interest rate trajectories to policy risks. Let me explain what this really means in everyday terms. When a giant like BlackRock reduces exposure to U.S. debt instruments, it's like the captain of a massive ship steering away from rocky shores, and the ripples affect everyone in the water. Right now, as we speak, U.S. interest payments on debt are consuming more budget than defense spending, forcing more borrowing in a vicious loop. But here's what nobody connects quite like this. Larry Fink, BlackRock's CEO, has been vocal about these dangers. In statements from early 2026, he highlighted how escalating debt levels threaten overall economic confidence, potentially leading to sudden spikes in borrowing costs if growth falters. He even cautioned that without sustained 3% U.S. GDP growth, which is far from guaranteed amid current headwinds, the path becomes increasingly risky. This isn't about one person's opinion. It's the perspective of someone steering trillions through turbulent waters. Think of it like this analogy. Imagine your household budget. If you max out credit cards to cover bills, eventually lenders charge higher interest, and one day you can't borrow more without cutting essentials. Scale that up to a nation, and you get the US situation. Debt service crowds out investments in infrastructure, education, or healthcare, hitting the middle class hardest. And BlackRock's pivot? It's strategic. They're underweight on those treasuries, while exploring alternatives like tokenized assets, where real-world items like real estate or commodities are digitized on blockchain for efficiency and resilience. According to industry forecasts, this tokenization market could reach $10 trillion by 2030, offering a hedge against traditional debt fragility. Now, here's a twist that adds layers to this. Fink has also addressed broader shifts, like reversing course on certain DEI initiatives, noting that in a world of AI and automation, the dynamics of labor and immigration change. But this ties back to the core cycle. Geopolitical and technological pressures accelerate debt issues. For example, right now, as we speak, foreign investors such as China and Japan have been trimming their U.S. Treasury holdings by hundreds of billions over recent years, per Treasury International Capital data. China's holdings alone dropped from a peak of $1.32 trillion in 2013 to around $682 billion today, a reduction of over 47%. This isn't random. It's a response to sanctions risks and de-dollarization efforts in groups like BRICS, where nations are experimenting with non-dollar trade settlements. If you've ever felt like global events are distant until they hit your wallet, this is how. Less foreign buying of U.S. debt means higher rates for everyone, from home loans to business financing. And here's exactly why it often feels like a scam or rigged game, as so many people sense. The top 10% of Americans hold about 90% of stocks, according to Federal Reserve surveys. So when debt-fueled inflation boosts asset prices, they gain, while wage earners like you face higher costs for basics. This wealth transfer isn't a conspiracy in the shadowy sense. It's economic mechanics at work, amplified by policy choices. Take a historical parallel. In the lead-up to the 1929 crash, debt bubbles in stocks and real estate created similar divides, leading to the Great Depression where the middle class suffered most. Or in 2008, when subprime debt exploded, bailouts protected institutions while millions lost homes. Today, with AI adding to borrowing demands, BlackRock warns it'll require massive investments. The pressures mount. But here's where it gets even more intriguing. Fink praises emerging markets like India, calling the next 20-25 years their era due to digitized economies and stable growth. India's rupee advancements in tokenization put them ahead, per BlackRock's own insights, signaling a power shift eastward, much like from Europe to America last century. This isn't about fearing change. It's about seeing the cycle for what it is, a redistribution where those who understand reposition early. If you've wondered why elites seem insulated, this explains it. They map risks like BlackRock's geopolitical dashboard, which flags U.S. policy volatility. But this is not inevitable doom for you, it's a call to awareness. Right now, as we speak, the dollar's share of global reserves has dipped to 58% from 70% 2 decades ago, per IMF stats, a slow erosion that mirrors past currency declines. And with tokenization on the rise, elites are hedging into digitized real assets that offer transparency and lower fees, as Fink describes. This cycle phase, what we can call the silent exodus, is where wealth quietly moves, leaving the unprepared behind. Now let's bring this home and explore what these debt cycles truly mean for someone like you. Because while the headlines scream about trillions, the real story is in how it trickles down to your daily life and long-term security. If you've ever sat down with your family budget and felt that frustrating gap between income and expenses widening, despite working harder than ever, this is the invisible force at play. The $38.56 trillion debt isn't just a national problem, it's a personal one, manifesting as inflation, that hidden tax no one votes on, but everyone pays. With interest costs now rivaling or exceeding major budget items like defense, the government has less room for investments that could boost growth, leading to higher taxes or cuts that hit middle-class programs hardest. But here's what nobody tells you in simple terms. Inflation from debt debasement acts like a regressive force, disproportionately affecting those living paycheck to paycheck. Your groceries, gas, and utilities climb, while wages lag, a pattern seen in every historical cycle we've discussed. Right now, as we speak, this means your savings could be eroding faster than you realize. Consider a real-world example. If you had $10,000 in a savings account, earning minimal interest, inflation at even 3 to 5% annually, which debt pressures can sustain or worsen, shaves off hundreds in real value each year. Scale that to retirement funds, and over a decade, it's thousands lost. And with the dollar's reserve status slipping, down to 58% of global reserves from a peak of 70%, import costs rise, making everything from electronics to food pricier. This isn't scaremongering, it's the math of cycles where currencies lose dominance, as with the British pound post-WWII, when everyday Brits faced rationing and austerity, while elites diversified abroad. If you felt that sense of unease about the future, wondering if your kids will have the same opportunities, or if retirement is a pipe dream, this explains the root cause. Debt cycles amplify inequality, transferring wealth upward through asset inflation, while debasing wages and savings. But here's a deeper layer that's often overlooked. These consequences extend beyond finances to societal strains. Historical parallels show that high debt eras lead to unrest. Think the French Revolution fueled by royal debts, or the 1970s U.S. stagflation breeding cynicism. Today, with AI and geopolitical tensions adding borrowing needs, BlackRock warns of potential volatility spikes. For you, this could mean job market shifts, where automation displaces roles, or higher rates locking you out of homeownership. Now here's where it gets personal and hopeful. You're not powerless. Recognizing this as a phase in a 500-year pattern, expansion to peak, then contraction and reset, shifts the narrative from victimhood to preparedness. Resets often bring innovations, like the post-1929 New Deal or post-2008 tech surge, creating new wealth paths. If you've asked, how do I break free from this trap? The answer lies in education. Seeing the signs early, like BlackRock's pivot, allows you to adapt without panic. Let me walk you through some practical educational frameworks drawn from these historical patterns. And remember, this is for informational purposes only. I'm not a financial advisor, so always do your own thorough research and consult qualified professionals before making any decisions. The goal here is to empower you with timeless principles that have helped people navigate debt cycles for generations, without any hype or specific recommendations. First, start with building a solid foundation of awareness. Make it a habit to track key indicators like the debt to GDP ratio, available freely on sites like treasury.gov or imf.org. This isn't about day trading, it's about spotting trends early, much like how BlackRock uses dashboards to monitor geopolitical risks. Understanding that ratios over 100% often signal contraction phases can help you anticipate inflation pressures and adjust your mindset accordingly. And here's a straightforward educational approach to diversification. History shows that spreading knowledge across asset classes can provide resilience. For instance, learning about real assets, those with intrinsic value tied to physical or productive uses, has been a common thread in surviving debasements. Think of how gold served as a store of value during Spain's fall, or stocks in productive companies during Britain's reset. Today, exploring concepts like tokenized assets, as Fink discusses for efficiency and democratization, could be worthwhile study. The market is projected to grow significantly, offering insights into future trends. But focus on education. Read reports on blockchain basics to see how they reduce fees and enhance transparency. Now, here's where it gets actionable in a general sense. Consider frameworks for personal debt management. If national debt hypocrisy teaches anything, it's to minimize your own leverage. Aim to build emergency funds covering 6 to 12 months of expenses, as general financial literacy resources suggest, to weather volatility. This closes the pain of feeling vulnerable to rate hikes or job shifts. Another timeless strategy: invest in skills and networks. Cycles reward adaptability. During resets, new opportunities arise in innovation or emerging markets. Educate yourself on global trends, like India's digitized economy that Fink highlights for its growth potential, to broaden your perspective. Finally, foster community. Join discussions on economic history forums or books clubs, not for tips, but to share insights on patterns. This builds resilience, turning isolation into collective wisdom. Always prioritize professional guidance. These are just educational lenses to view the world through. Right now, as we speak, the $38.56 trillion debt cycle is unfolding, but with historical patterns as your guide, you're better equipped to protect what matters. From Spain's gold fleets to BlackRock's warnings, the lesson is clear. Knowledge turns threats into opportunities. If this helped clarify why elites pivot while you feel the squeeze, like and subscribe for more timeless breakdowns. Hit the bell. Next, tokenization's role in cycles. This is educational only. Consult pros. Thanks for joining. Your future starts with awareness.